The topic that we're looking at discussing, or rather deliberating and putting together our thoughts, actuaries in banking. I would want to link it somewhere to the theme of the GCA, which is expanding the horizons while strengthening the core, right? So what we are saying is that as actuaries, are we expanding the horizons? Are we exploring different areas? While at the same time, we are strengthening the core. Now, what is the core that an actuary can boast of? Understanding of models, risk management, and add a flavor of business understanding on top of it, right? So what we are saying is, as actuaries, are we there? Are we well placed that we are strong in risk management? We know how to put together the models. And at the same time, given the flavor of the dynamics of the business, are we in the sweet spot to actually crack it? And the answer to us on the dais seems yes. But yes, let's spend the next 60 minutes discussing it. So what we've done is we have a small session. I'm just waiting for the slide to come up. Just get the slide up. So if you were to deliberate and see that what is it that actuaries can bring to the table or add value to, just put up the slide. Give us a minute. Yeah, perfect. So if I were to look at what is it that an actuary can contribute to, and we were just brainstorming, we tried plotting, we said that credit risk is one area, market risk is another, operational risk, liquidity risk, ALM, scenario, stress testing and stuff. Now all these sound very mundane. You could potentially argue and say, boss, there's nothing new that you're telling me. And this is something that we do day in, day out. But hang on, one thing that's present on the slide, I have not talked insurance anywhere. I haven't said that you can only do these life insurance or for a PNC or a general insurance or a health insurance or for an employee benefit scheme. I'm talking about these aspects in general. So I'm saying, can an actuary add value in a credit risk role? The answer is yes. Can one add in market risk, operational risk, and so on and so forth? The answer is yes. And to prove that, I think we've invited a very strong personality, if I may say. We are privileged to have Michael with us. He's coming from South Africa. Just a brief on Michael, as in we were chatting up yesterday and today morning, what touched upon and struck me was he is a pensions actuary. So he qualified in 2000 as a pensions actuary. 2009 or thereabouts, Old Mutual was going through a reorganization and internal restructuring and stuff. And that is where he latched on to banking. From 2009-10 till 2011-12, he's been at the forefront of setting up and getting involved in various, banking specialized roles. So a pensions actuary at the core, but at the same time using that skill set, that knowledge, that know-how, and expanding into the area of banking. Fast forward to 2015-16, he has been leading the entire pack in South Africa, and to the extent that there is a dedicated course on banking, students can go ahead and take exams in a banking specialization. Like we've got life, general, health, pensions, investments. There is a specific course on banking. And these students are taking that course for the last more than 2 years now, 3 years. So that's on Michael. We've got a couple of other speakers. We have Vijay, he's a financial engineering specialist. He's here to share what he's done as a part of his PhD thesis. So he's going to be defending his PhD thesis a week from now, right? Yeah. And he's kind of developed a model which can help you forecast or predict whether a bubble is around the corner or an asset is in a bubble format. We've got Yash. He's got more than 5 years of experience. He's here to share his understanding and the econometrics that he's deployed in banking as a sector. Before I hand it over to Michael, a quick trivia. How many fellows do you think would the Institute and Faculty of Actuaries have in the areas of banking and investment? Any guesses? Less than 100? Show of arms? Okay. Between 100 and 500? Okay. More than 1,000? Oh, people do believe. More than 2,000? No one believes me. The number is close to 2,600 odd. Actuarial Society of South Africa, number of professionals working in the area of banking and finance, less than 50? Now, no one's going to raise their hands, right? More than 1,000? There are a few brave souls, okay? Actually, the number is close to 350 odd. So there are 350 odd actuarial professionals who are working in the area of banking and finance, with close to 60 odd qualified fellows in that area. On that note, I introduce and hand it over to you, Michael.
Good afternoon, ladies and gentlemen. I've already been introduced, but I would like to warn you that this session required about 10 hours, but we were only allocated 1 hour. So we will try and do everything within the 1 hour. Sorry, we have got slides. Okay. So what we're going to do, just to set the scene, is I'm going to speak for about 8 to 10 minutes, just to introduce the topic of actuaries in banking. And then we have got two other speakers, Yash and Vijay, who are going to speak about some technical work that they actually do that is relevant to banks. So this is the agenda, just to set the scene, where we will start with introduction and the background. And then in the end, we are going to have a mini panel discussion with some questions. So during the sessions, we please take note of any questions that you have, and you can ask us at the end. Now, as a way of background, you'll be surprised that actuaries have been involved in banking for some time, between 10 to 15 years. And in South Africa, as Kailash has already mentioned, there are about 350 actuarial professionals with more than 60 fellow actuaries working in the banking space, both within the banks as well as consulting companies. We think that this is actually going to continue. It's a trend that's not going to go down. And the purpose of our session is first to just share the knowledge that we have and our experiences, but most importantly, to encourage individual actuaries to take action and move into banking practice if they have interest. But first, let's just think about the skills set of an actuary. This is basic. This is something we already know. We always want to keep referring to it. The quantitative skills are the main ones: statistical and mathematical ability to do some modeling work. Then we also have got understanding of business in the financial services sector. And there are many other attributes that an actuary has. One of them, the important one, being communication, where we need to be able to communicate our work. Now, if you look at this skill set, this is what allows actuaries to move into any area that they need to be. And this is what we have seen when actuaries were moving into banking in South Africa, for example. These are the skills they were effectively deploying. But I'm not going to go into detail. There's another session where we may end up talking more about this. And this one is an important slide. And it's quite a busy slide. These are the different areas that we see actuaries working in South Africa within the banking space. For example, and I'm going to give just a few examples, product development, product research and development. We find a number of actuaries involved in there, from the design, the pricing of the product, and even the maintenance of the products. Then when it comes to risk management, credit risk is the biggest aspect of banking work. And whilst at credit risk, this is not new. This is already being performed by a number of actuaries in the general insurance space where credit guarantees are offered. So the work is similar. So within credit risk, you find a lot of actuaries building models for provisioning, building models for monitoring credit risk. It's just a wide range of work that actuaries get involved in. Another interesting one is customer value management. I'm just picking a few. Customer value management, there's a lot of data, especially in retail banking. And you'd find that we have a number of actuaries employing data analytics, working with big data, analyzing customer behaviors, and understanding how customers actually behave, how they buy, to allow on-selling to customers, to allow understanding of the profitability of a particular client. So there's a lot of modeling work that happens, and we have got a number of actuaries involved in that space. Others are IFRS 9. I think IFRS 9 is quite an important one. It was introduced from 1 January 2018. The expected credit loss provisions, which are forward-looking, we find that a number of actuaries are involved in developing those models that are required. But there's a lot where actuaries are already involved in. So it's not like where they can be involved in. They are already in there. They are already doing the work. Moving to that slide, I just wanted to give an example where you can see actuarial techniques being applied in banking. So here I've given insurance example and banking example. And this slide, you always see it in most of my presentations if you follow them. So in the insurance space, we've got probability of claim, but in banking, we say probability of default, that a loan is actually defaulted. So it's actually very similar concepts. If you come to the diagrams down there, on the insurance side, you talk of a person being healthy, moving into the sick, into the sick category, maybe terminally ill, and then die. The only difference is that when you die, it's an absorbing state. But when it comes to banking, a loan is healthy, being fully serviced, but it can also move into default. It can move into, once defaulted, it becomes a non-performing loan. And then after some time, the loan can be written off. The only difference is that you don't get into an absorbing state. A loan can actually move out of a default back to healthy loan due to a number of actions that a management of a bank may take. So this is quite a good example, which you apply when you are doing your modeling in the credit space. Specifically, if you are calculating expected credit loss, it is really a function of the probability of default multiplied by what we call loss, given that there is default, multiplied by your exposure at default. That is the outstanding loan at that time. And that's why I show this diagram, because it's very similar with what you do with insurance and where you apply survival models to calculate probability of default, or some of you understand it as Markov chains. There are many other examples we can give, like application of chain ladder methods when you're reserving, when you're calculating provisions. So that's an example I normally give. We carried out a survey. I do chair the IAA Banking Working Group, and we carried out a survey just to understand globally what actuaries are doing and how they think about banking. 810 respondents from 37 actuarial associations. The results were quite interesting. We found that 56 of the respondents would consider qualifying as a banking fellow, and 75% of the respondents asked that they need to be included in any banking communication that's happening, and they provided their contact details. And then we categorized the actuaries in terms of whether they are in banking or they are not. 54% worked in banking and 46% did not work in banking. Of those 46%, 73% said they are going to consider moving into banking because of the interest that they have got in the work that is carried out in banking. So that's a survey we carried out, which gives us insight on what's happening around the world. This is a slide I would like to end with. It relates to Actuarial Society of South Africa, where we introduced a banking subject. we said in South Africa, banking is no longer wider fields. So Sanil opened up talking about wider fields. In South Africa, banking is no longer wider fields. Banking is now a practice area with a committee specifically for banking. And we had to launch a subject to assist actuaries or actuarial students who want to qualify as actuaries. And the subject covers all aspects of banking, from understanding the banking marketplace and the regulations, and then understanding the banking risks, which is your credit risk, operational risks, market risks. Under market risk, you've got interest rate risks. Then we also cover balance sheet management and asset liability management, where we look at liquidity and funding risk management under that section. Then we also said we want actuaries to become CEOs and executives of banks. So we do cover strategy setting. We also do cover governance issues in that subject. And then we really emphasize problem solving, like complex problem solving within a banking institution. So that's the subject that South African actuaries are offered since 2015. And with that, I would like to leave it to the other two speakers. The other two speakers are going to speak from a technical point of view. So we are going to give two examples of the work that they do that is applicable in banking. So one of the presentations is on volatility modeling to identify and forewarn an asset bubble. And the other one is on application of econometric models in banking. Then from there, we're going to come back. I'm going to come back, and then we can have a few more discussions, and then we will take questions. The questions, we have some of them that we are going to discuss as a panel discussion are there on the screen. Thank you.
Good afternoon, ladies and gentlemen. I'll be presenting a methodology to identify and forewarn a financial bubble, essentially an asset bubble. So this methodology is very contextual, and it touches all the fields, all the three fields of quant finance, which is financial engineering, investments, and risk management. So as has been pointed out, this is a part of my PhD thesis. I'm pursuing PhD from the Oklahoma State in the US, and within a couple of days, I'll be flying back to the US to submit and defend my PhD. So I have completed my analysis, and I hope that you find my research interesting. Now, this is a very pertinent topic for an investment manager, and you see that investments is a core tenet in insurance also, because investment managers in insurance companies, they invest in bond markets and equity markets as well as other assets. So many times a particular asset may be one single stock or a group of stocks, a sector, or a complete stock market. It is trading at very high valuations. So investors and traders, they want to know whether these assets, they are trading in a bubble territory so as to prevent potential losses in the unfortunate event of a bubble burst. So my methodology, which is actually a statistical test which flows from the principles of stochastic calculus, it helps identify and forewarn if a particular asset or group of assets, say for example a stock index or a complete market index, if it is trading in bubble. So let's start. So this is the structure which I will follow. First I will explain and discuss financial bubbles, and I'll be using the terms financial bubbles and asset bubbles interchangeably. And then I will talk about the mathematical theory behind bubbles and the statistical test underpinning the principles of stochastic calculus. And finally, I'll present my results of backtesting this methodology on Bitcoin in the year 2017. So in the first section, when I talk about the financial bubbles, I'll explain what characterizes a bubble and what are the different stages of bubble building and what are the reasons that a bubble gets created. So a financial or asset bubble is characterized by very high trading volume and a quick fire rise in the market price. And this is caused by abnormally high and unrealistic investor expectations about an asset, and due to sustained mispricing, means the market price of an asset is consistently remains very high as compared to its fair value defined by its fundamentals. So during a bubble, market price and valuations, they remain at very high levels. Price rise is dramatic, and when the bubble gets burst, so often the fall is as dramatic and swift as the price rise, so which you can see in the graph. So different stages of a bubble. The first stage is displacement, which happens when there is a paradigm shift in the economy due to a government policy or some business or technological innovation. Now, an example would be the US government policy, the Clinton administration policy in late 90s. So they reduced lending rate to such an extent that an average American and the lenders in the real estate industry found it very profitable proposition to give out real estate loans. So this caused within a few years a bubble in the real estate sector, which eventually burst in 2007. And the second stage is boom, in which the asset price starts marching ahead. There is a credit expansion, and the investors, they start investing even while taking money on loans. So the volatility is low, and the price movement is mostly unidirectional. The third is euphoria, when suddenly the asset cannot do anything wrong. So more and more investors, they join the party, they join the bandwagon, and there is a fear of losing out. So when investors, they see that other people are making money, so why shouldn't they also? So they join the bandwagon, and resultingly the trading volume escalates. But in process, the volatility also rises to very high levels at this stage. And so what happens is that after this stage, some astute investors, they start sensing the trouble. They have an insight because of their experience and expertise in the market. So they start realizing that things are overheating, and then they start booking partial or full profit. So this is the profit taking stage. And finally is the bubble burst. So at the start of this round, this is the end. So the news of very high valuations and the bleak future of that asset starts doing the round. Investors, they lose confidence and start dumping the asset. And even a minor event is sufficient to prick the bubble. And there is a sudden fall, swift fall in the asset price. So these are some reasons of financial bubbles that as to how they are created. You see that right from the 16th century, which is the tulip mania in 1636 is the first recorded asset bubble, which happened in Netherlands. And many people, including the famed scientist Newton, also lost significant amount of money in that bubble. So the world, the globe, it has seen number of bubbles, and which makes it a very important and interesting topic. So the reasons of financial bubble are, the first reason is obviously the irrational expectations of investors. The second reason is about an asset per se, that this asset must be tradable and durable and resaleable. So most of the investors, so-called investors in this asset, they are actually momentum investors. So they plan to keep the asset only for a short duration of time, and then they hope to resell it at a profit. So the third reason is, which I talked about in the displacement stage, the very first stage, some kind of business or financial innovation. And an example would be an e-commerce bubble of the late 90s, in which suddenly people started thinking that e-commerce is obviously the future. In late 90s, they were thinking that Amazon will quickly replace the brick and mortar model, which did not happen overnight, but this is what investors were thinking. So, so sometimes it is like investors, they think much ahead of time. And finally, some kind of new infrastructure. For example, some big trade route is created, or some big network of railroads, or the roads are created. So this may also result in financial bubble. And obviously government policies, for example, in the US, we see that the next bubble may be caused by burgeoning student loans. So it's a government policy of, due to which students are getting easy loans, and the universities are not reducing their fees. So now that we have a theoretical grounding in financial bubbles, so let's discuss the mathematical theory behind the bubbles and the statistical underpinning. The theory of martingales, which essentially is a theory in stochastic calculus, is helpful in modeling financial bubbles. So we use the concepts of martingales, the theory of martingale, and strict local martingales in this. Now, as we know, martingales are random. They are also known as random walks, in which the system doesn't have any memory, and any expected value at a point, it is just equal to the value at the preceding point. So the immediate next value may be positive or negative, wherever it is. In the case of strict local martingale, the lower bound of the next point, the successive point, is the preceding point. So which means that the process quickly rises to very high levels. And this is also a typical behavior of a bubble, that price escalates to very high levels very quickly, and then it falls down and remains at the low level. So we use the strict local martingale process to model financial bubbles. So I understand that this might appear to be technical, but I'll not go into much depth. So this is just one slide. I have just mentioned the terms martingales and strict local martingales, and then I'll talk about my empirical results. So the stochastic asset pricing model this is the standard model which is used in the research. It has deterministic and drift components, and so we'll directly come to the criteria for the bubble. The bubble criteria is that during a period, the average volatility, price volatility, must be very high. because of obvious reasons. The second is that volatility should increase with price, which is also logical because when market price increases, so general understanding is that it is getting more and more detached from the fundamentals, and thus some people will sell and some people will buy. So this will make it very volatile. And the third is this particular integral, that the process is a strict local martingale. If I'll speak out, this is integral, a definite integral from epsilon, which is a small positive value, up to infinity, x by sigma x square, where x is the price and sigma is obviously volatility. So price volatility is sigma x, dx is less than infinity, which means that this integral, this definite integral up till infinity should yield a finite value. And when will this happen? This will happen when the price volatility, when the price becomes very high, when the price volatility also becomes very high, so in that case, this condition will hold. So now our criteria are very simple. The average volatility should be very high during the period of analysis. And second, the volatility should increase with price. So these are the two principal criteria for identifying an asset bubble. So the statistical test is that I run a program on high frequency data of that asset, and the high frequency data would be a minute or a second's data, and then I model using any stochastic volatility estimator. Like for example, I used an estimator that was promulgated by a French researcher called D. Florence Zimrou in 1993 that estimates price volatility at each price point during the period. So this is it. So once we estimate price volatility as a function of price during the period of analysis, then we arrive at our result whether there is a bubble in that asset or not. So this is a very useful test which can be applied to any highly traded asset, may it be individual stocks or stocks or bond ETFs or commodities, agricultural commodities, crude oil, precious metals, cryptocurrencies, or even the complete stock market. The only mandatory condition is that that particular asset should be very frequently traded so that it generates high frequency data. Because this methodology cannot be applied to illiquid assets like corporate bonds or even real estate transactions. However, this can be applied to real estate stocks or real estate trusts also that are frequently traded. So, so this was about the statistical test and the methodology. Now I'll talk about, I backtested this methodology on Bitcoin. Now Bitcoin 1 year back was a big fad, and every sincere or flippant investor wanted to know whether he should park a part of his portfolio in Bitcoin or not. So I'll talk about the Bitcoin price movement and why I considered Bitcoin for the backtesting. And I will display my results for some periods. And then I'll show some volatility graphs for bubbles and non-bubbles. So this is the reason which made nearly every investor across the globe seriously notice Bitcoin. Because in 2017, Bitcoin increased from the level of $998, which is close to $1,000, up to $20,000. Because Bitcoin highest price of Bitcoin, which was achieved on either 19th or 17th December of 2017, it was 19,999. So exactly 20x price rise in less than 1 year. In fact, in the month of from January to sometimes in May also Bitcoin came down to the level of 1,000, but suddenly there was an explosion in the price. So this is it. So these are some of the stages, especially the last two stages, in which the last stage is, Bitcoin is very volatile. The second last stage, you see that there was an explosion in the price. The line is nearly vertical. So I'll display some of the results of backtesting on some periods. The first period is an 8-day period from 11th March to 18th March. And as we can see that the average volatility is quite low. Means on the y-axis is volatility and x-axis is price. So average volatility is quite low, and as price increases, volatility is actually falling. So the inference is no bubble during this period, 11th March to 18th March in 2017. Now the next period is 27th March to 27th May, 62 days, when Bitcoin rose from 960 to around $2,800. We can see that the average volatility is greater than the last. You can see the axis. It is from 0 to 1,000, whereas it is from 0 to 8,000. So not only is average volatility higher in this period, but also it is increasing with price. So the inference is a bubble. The third period is from 25th September to 24th October, 30 days, in which Bitcoin rose from 3,666 to 6,178. Here also we see that price volatility is at average is very is high and increasing with price. So again, inference is a bubble. And finally, the last period is 31st December to 7th January. Now this you see that average volatility is at the highest level. This is from 0 to 16,000, and though it is not, you can't make out whether it is increasing with price, but across the period it remains so high that it is easy to infer that the asset was in bubble. And Bitcoin moved from 12,540 to $17,222. So these are the 4 representative periods. Now let me show you some more charts, illustrative charts of volatility for different periods when the bubble is present. So this period you see, again the volatility is high, average volatility, which is increasing with price. And the second one, again 0 to 8,000. The first one also was 0 to 8,000, increasing with price. The third one from 0 to 25,000, and volatility generally remains high across the period. And the last one, it is from 0 to 100,000, and again increasing with price. So these were some of the volatilities that my stochastic volatility estimator by Florence Zimuru, it estimated for each price point. So this is it. And as compared to that, the volatility, if bubble was absent, if the inference was that the bubble was absent, you see the volatilities. It is from 0 to 500, and no clear-cut trend. So no bubble. The second one again, it was from 0 to 250 or so, and generally at low levels. The third one from 0 to 600, though it is increasing with price, but generally volatility is so low that either the result is inconclusive or no bubble. And finally, 0 to 900, this also is no bubble because volatility first falls, then increases, again falls. So this is it. So this is the methodology which was successfully tested on Bitcoin. And I proved that Bitcoin in fact was in bubble in 2017. So this is the summary of the tests. So we can see that Bitcoin was in bubble from March to May, and then again May to June, and in the second half of July, and from September to December, it generally was in bubble because you can see 15 September its price was $2,960, whereas in December itself it rose to as high as $20,000. So obviously this is a characteristic of a bubble that too early, too fast, too high, but the statistical test confirms whether or not it was in bubble or not. So this was my presentation. It's a very practical and relevant research for investment managers, traders, and risk managers. And this is what it makes relevant for any insurance platform like the Actuaries one. So yeah, so that's it. Thank you very much.
Good afternoon, everyone. I hope you all had a good lunch. So just to wake everyone up, I think I was having a discussion with Frank, and he said, say something provocative to, wake everyone up. So I think we as actuaries, the first thing when we say is we love making models, right? We love complexity. And we like to play with numbers, and we love to play with complex things in general, right? A fundamental point to this entire model development or any modeling exercise is that the end outcome of the model is the most important thing that matters, right? And the people who are understanding the end outcome are generally people who do not come from a technical background. And that is why my session today on application of econometric models in banking will be covering 2 points. It will be covering what econometric models are, how they get applied in banking, and why is it so important for models to generate intuitive results. We don't want models to be black boxes. We don't want complexity that overrides business intuition. And that is why we are going to be focused upon econometric models. Yeah. So quickly just running through my agenda, I'll be setting the context and talking about what are econometric models and why have econometric models suddenly being started using in the banking industry. I'll be walking through a case study wherein we've developed an econometric model for a US-based investment bank using a hypothetical data set, following data preparation, model calibration, and forecasting, and finally some key conclusion and takeaways. So coming with econometrics, the basic fundamental of econometrics is that it combines economic theory, mathematics, and statistics. So you are essentially combining business judgment using business intuition. You're getting into play macroeconomic intuition with macroeconomic variables. And finally, you're looking at robust statistical frameworks. And the combination of all these three elements gives you an intuitive model while retaining its accuracy and predictive power. So the key drivers that have led to the increase of the usage of econometric models in banking are primarily four. There are new regulatory frameworks that are coming along. Going back to 2007, 2008, we saw what exactly happened with most of the banks in the US industry and primarily across most of the developed economies. I think the regulations now are more forward-looking. The banks can't wait for a particular default or a particular event to happen and then call it a particular provision, right? So they need to be more prospective, they need to be more forward-looking, and that's why the regulations ask for more forward-looking models. There is a need for intuitive model output. As I said, there have been very fatal experiences with black box models, and the idea here is to get a very simple output from a model which can be interpreted by anyone with business judgment. Moving on is data availability and access to compute power. We've experienced an entire economic cycle over the last decade thanks to the recession in 2007, 2008. So we have an enough amount of data to train our models to get accurate results. And computing power has, of course, increased our ability to develop more complex models and to come up with better predictive results. And finally is the desire for efficient capital planning. Capital planning is very, very crucial for bankings. They need to be forward-looking. There is an intensified scrutiny by stakeholders these days. And for those reasons, econometric models actually help a lot in developing a forward-looking capital plans. Briefly going into the overview of what my case study would be, what I'm trying to do is I'm trying to forecast the losses from an equity portfolio of a US-based investment bank by making an econometric model. I will be forecasting the losses over the next 13 quarters under various different macroeconomic scenarios. The regulation that I'm trying to mimic here is called the CCAR. It's called the Comprehensive Capital Analysis and Review. It is actually a regulation in the US markets by the Federal Reserve, wherein the Federal Reserve after the 2007-2008 came up with a stress testing guideline saying that you need, for telling all the banks that you all need to prove that you all have enough capital if there's a recession again. And I want you all to prove that using an econometric model which can give me results under different adverse scenarios. So this is typically a model development life cycle that we look at, wherein we start off with discussing the problem statement with the stakeholders, we identify data, we do data cleansing, we go to variable selection, specifying the model framework, do a lot of statistical testing, performance testing, stress testing. Finally, there's an independent model validation. There is a model sign-off and implementation before actually rolling out the model officially. So given the lack of time, I won't be covering each of these in the details, but if any one of you all want to have an offline chat after this particular session, please feel free to do so. So the first step is around data collection, where we basically collect both internal and external data, internal being specific to the idiosyncrasies of the particular bank, and external data like macroeconomic data and other industry data. We clean it, we transform it before putting it into a model. We define the independent variable as the second step. In this case, we're looking at the equity portfolio of the bank from the period 2005 to 2017. We then go on to selection of variables. We create a universal set of various types of variables. There are productivity and income variables, employment and inflation variables, exchange rates, indices, financial market variables. And this allows us to basically come up with an initial set which is exhaustive enough, which we think would be able to predict or explain the behavior in our particular balance sheet. What we then do is, because we can't of course use several variables at one time, because there's a concept of basically using too many at one time will make your model overly complex. There's a concept of multicollinearity, which I will not get into right now. But the basic fundamental idea is that if you use too many variables at one time, there is going to be an overlapping effects. So you need to basically choose variables very carefully, and you need to ensure that you are only taking those variables that are actually going to be explaining the causation effect behind your dependent variable. So what we do is we run some correlation analysis, we run some cross-correlation analysis. From a quantitative perspective, we supplement our quantitative analysis with qualitative graphs along with the dependent variables. So we have money supply, business confidence index, consumer confidence index, the USD euro exchange rate, the BBB corporate yield, and the commercial real estate index. So just an example, you can see the BBB corporate yield. In 2007-2009, the BBB corporate yield increased significantly, and our equity portfolio dipped at that point of time. That clearly shows a negative correlation between the BBB corporate yield and our equity portfolio, which also seems to be economically intuitive. Moving on to model calibration, for the purpose of this particular exercise, I'm not trying to make a very complex model because that is not the purpose of this particular session. There are a lot of various types of econometric models that you all can work on. For this particular session, I'm focusing on a simple OLS model with a log transformation, wherein I've selected two variables, the commercial real estate index and the BBB corporate yield. As you all can see from the model coefficients, there's a positive correlation between my equity portfolio and the commercial real estate index, and a negative correlation between the BBB corporate yield and the equity portfolio. Moving on, we do some standard routine statistical tests for all the people who love statistics to ensure that our underlying model assumptions are met, covering stationarity, linearity, multicollinearity, normality, heteroscedasticity, and serial correlation. Again, if you want to have an offline chat on the technical aspects, we can connect after this particular session. Finally, we backtested a model. We conducted both in-sample and out-of-sample backtesting to ensure that our model is predicting accurate results. We compute some measures like RMSE and MAP to give us an idea of how well our model is performing. Post that, what we do is, before moving on to the final forecasting stage, the variables that we've chosen, which are the BBB corporate yield and the CRE, we forecast them in the future. Now, what happens in the US markets is that the Federal Reserve or the regulator themselves provide the forecast of these particular variables. But in cases the bank wants to themselves make internal models to even forecast these macro variables, they have an option to do so. So in this particular case, we have a forecast for both commercial real estate and the BBB corporate yield across three different scenarios. which is baseline, adverse, and severely adverse. Baseline meaning everything is fine, it's the normal, the usual business. Adverse meaning things are getting a little bit bad in the market, and severely adverse is mimicking something like a recessionary scenario in the economy. So if you can see the triple B corporate yield, you will see that there is an increase in the triple B corporate yield in the severely adverse scenario. And in the commercial real estate, there's a decrease in the severely adverse scenario, which makes more sense because under a recessionary period, you would expect your spreads to increase on triple B corporate bonds. And at the same time, your commercial real estate market won't be really performing that well. Finally, using those forecasts of independent variables and our initial model calibration results, we forecast the equity portfolio of this bank over the next 13 quarters. And as you all can see, our particular model, it predicts that under the baseline scenario, there's going to be a $5.18 million loss for the bank. Under the adverse scenario, there's going to be a $8.78 million loss. And under the severely adverse, there's going to be a $17.63 million loss. And as you can see, these are intuitive results because if you looked at the model calibration results as well, it moves in line with the economic variables that we initially chose. So it clearly shows that this model is not trying to project something that is not economically intuitive. This is complete intuition here. Finally, the key takeaways of my session covering the end-to-end case study are 4 things. Firstly, forward-looking capital plans. Given the regulatory pressure and the intensified scrutiny by stakeholders, econometric models have become a must to basically forward your balance sheet or your P&L statements. Intuitive risk analysis, can't reiterate that enough. Models aren't supposed to be used as black boxes. The end outcome of a particular model is so that everyone understands it. Finally, regulatory compliance, forward-looking regulation like CCAR, IFRS 9, CCL, FRTB, IRBB. These are all regulations in the banking space that have just come up over the past years, and there's one thing that is common across all of them, forward-looking projections. And that's where econometric models come into play. And finally, actuaries and econometrics. I think it's pretty common or pretty self-explanatory that econometrics is a combination of multiple disciplines. It's not just one. So it's a mixture of economics, financial theory, mathematics, statistics. And guess who else has those combinations? Right, those are actuaries. The way our curriculum is particularly designed, it allows us to come up and blend all these particular topics in one shell. So I don't think at this particular point of time, the amount of work that is happening on econometric model development and validation in the banking industry, I personally don't feel that other than actuaries, there are any other better people out there who can perform that role today. So my request to all of you all would be anyone who's looking to move outside from the insurance space to the banking space, please consider this as a great opportunity because it's a great time to get into the market. So, yeah. Any questions? I think Michael can take over from here and we'll take it from there.
Can you hear me? Oh, geez. Okay. All right. Thank you very much. So we just want to bring things into context. So Kailash did open up with a slide where he showed different areas where actuaries get involved in banking. And then we had VJ speaking about modeling for asset bubbles. And then Yash completed our discussion with an econometrics model that is applicable in banking. So let's have a look at, just summarize what VJ spoke about. Banks are very much involved. They are at the center when asset bubbles are happening. So 2008 financial crisis, those of you remember, where banks largely in the US held mortgages and they were unreasonable prices. There were a whole lot of things and a lot of hidden risks which led to a bubble bursting. So when banks are holding those assets, credit extension is high, leverage is high, interest rates usually are very low, and there's a lot of credit extension. But then when that bubble bursts, you find that there's a credit crisis and bank balance sheets actually shrink. So why is that relevant in banking if you find that this kind of work is being performed and can be performed by actuaries? Because there's a lot of work on capital modeling. There's stress testing involved in that process. There's a lot of work on liquidity risk management and stress testing is involved in that. So if you have models such as these that actuaries can build to be able to identify asset bubbles, then you can actually incorporate it in your work, and then it becomes very relevant work in banking. This is an example that we are giving from an expert in that area, but we are saying as an actuary, you can actually apply a lot of techniques that you already know in the banking space. Now let's go to Yash. Yash spoke about, this is a lot of modeling that happens. If I refer back to the banking subject that I spoke about, all this work is incorporated in there. For those of you who are CIRA or Chartered Enterprise Risk Actuaries, where you do a lot of statistical modeling, in there, you will find that most of the work you was talking about is contained in that. So effectively, you are building a model. You have to, you must apply best practice. You have data issues in the building of the model. And then you come up in the model selection. You come up in the selection of the variables that you must put into the model, and a whole lot of assumptions that you come up with in that whole process. And then you calibrate the model, and then at the end, you must validate the model using different statistical models, and then you have got your model results that you communicate. That happens in a lot of work that happens in banking. So he confined it to econometrics, but when we are doing credit risk modeling, you follow exactly the same process. You just have to choose the right approach. So there is a lot of relevance with what you already know before you even read anything else. But just the statistical and mathematical background you have, you can actually walk into a bank and look at what they are doing and apply that. So that's what we're trying to encourage everyone. Okay, so can we just have the slide that I used on question? So let's just go to question and answers. But before we look at the question and answers, I wanted to, okay. Let's just wait for that slide. I wanted us to look at the questions we normally ask. So we normally ask people who are practicing in banking, because there are a lot of actuaries practicing in banking, like I said. So we normally ask them questions, especially when we are sitting with an audience that does not have insight into banking. We normally want them to tell us their experiences when they're working in a bank or when they're doing banking work. I suppose Yash is going to share with us, as well as Vijay. We don't have enough time. Then we also ask questions such as, what challenges do you see that actuaries can encounter when they're in that space? We also ask questions of, what problems and challenges do you see our clients, which is the banks, experiencing that you think are relevant for actuaries? Then we also normally ask what you think are the skill set of an actuary that make them relevant to do banking work. You know, when we start unpacking those questions, when we start answering them, that's when you start realizing how relevant actuaries are in the banking space. And that's why we're going around the whole world encouraging actuaries to think about that at an individual level, take action, go out there, try and look for opportunities within the banking space. Right, so we should, so those are the questions that we're going to see on the slide anyway. I mean, I've got them because I normally ask them quite a lot. So let's now ask if there are any questions based on the sessions that have been presented right now. We don't have time to go through all these questions in detail, but do we have any questions from the audience? We probably have 10 minutes. All right, there is a question there. Any other question?
So, myself, Anirudh from AXA Business Services. So, this is a question to Mr. Vijay. So, when you said that you were trying to model a bubble, so in that context, when a portfolio is moving towards a bubble, there might be n number of assets. Whether it's when you are saying a Bitcoin, so there could be n number of assets which might at a particular point of time moving towards a bubble. So is there any model where you can predict that, okay, these are n number of models moving into one direction, and how do we address those?
Yeah. Do you need to come to me? Yeah. I'll just stand here.
See, there can be two approaches. Now, in this case, in the first approach, you segregate all the assets and treat them differently and conduct this test separately for each individual asset. Now, the thing is that you will conduct this test only for those assets which are showing a significant climb in daily prices, right? So first you will filter in only those assets which have very high daily price volatility, and then you will consider the high frequency trade data for those periods of these assets and find out whether these individual assets are in bubble or not. And the second case could be treat the portfolio as a whole and then find out the periods of high jump in daily prices and high daily price volatilities and find out whether the whole portfolio was in bubble during that period or not. So is this what you were asking?
So my question was more onto that how are the different assets related to each other, and how do we understand the collinearity between assets? Because when you are looking at a bubble context, so there might be n number of assets which might be moving in a one way and some might be moving in the other way. So there is definitely a collinearity between each of the assets. So is there any method in which you capture this collinearity and bring it to the marketplace, or is it done in isolation? So the idea
No, it is done in isolation, and actually this is, yeah, you're talking about the variance covariance metrics, right? So
yeah,
this,
it could be
that, this project scope doesn't involve the correlation among assets. So it treats all the assets which are moving very fast in isolation. And so essentially this is a project on asset pricing, right?
Okay, thank you.
All right. Thank you. Thanks, Vijay. Do we have any other question, technical question, or any other question you wanted to ask to our panelists? All right, I'm going to ask a question. So Yash, maybe I can see that you have been involved in some banking work, banking technical work. Can you just outline briefly some of the other work you are involved in banking, and the challenges that you see in banking that you think actuaries can actually provide solutions or value?
Sure. So firstly, thank you for asking that question. So I think when I started off my career in banking particularly, I think that point of time I was a fresher in banking for sure and didn't really know as to how does a particular bank work. So I think the first step was understanding the fundamental business of how a bank works. And I think the way we define banking is that any organization that gives credit comes under the concept of banking. Now, why am I saying that is, what I'm basically trying to say is that the actual skill sets that we learn throughout our entire curriculum, even though the session is on banking particularly, but any organization where there is a particular exchange of credit is where actual skill sets or techniques can be used to assess that risk. For example, I also have worked in the telecom industry, and we did a particular credit risk modeling for postpaid customers. So for example, I am a Vodafone user, and at the end of the month, if I do not pay my bill, right, Vodafone basically is running a risk of default on me. Similar to me, there are several such customers that Vodafone runs. And when all of them tend to default in a pattern, that's when they start making losses. Same situation in banking, when banks give out loans to customers and obligors or customers default, the banks start making losses. So anywhere where there is an exchange of credit is where there is uncertainty of whether or not that credit is going to come back. And that's where actuarial skill sets can be used to predict that uncertainty and try to quantify that risk. So yeah, and in terms of, I think, the other work that I've done on the banking side is asset liability management. On the banking side, there are, RBI is pretty, in India at least, is pretty strict on the way you're managing your balance sheet in terms of the way you're going to be matching your assets and your liabilities. So there's a lot of modeling happening on the ALM side. There's a lot of modeling on market risk because the kind of products on the banking side are pretty complex. There are derivative products, both standardized and OTC products, which require a lot of modeling and pricing work. And all of this is something that we actually study in our curriculum, even though it's not apparent, like as the way Michael was actually pointing out regarding the Markov chain process. I remember I was pricing a derivative which is called the credit default swap. And it was the first time when I was speaking with an analyst or a quant guy in banking, and he said that, this is how you price a particular CDS, there's a CDS pricing curve. And I was like, hold on. So you're telling me that the CDS is on a particular company, which is, if that particular company defaults, I'm going to get a payout. That is pretty similar to what we do in life insurance as well, right? Treat that company as a person living. That person dies, there's a particular payout, right? The only difference being that in banking we use a CDS curve to price that CDS, and life insurance you would probably use a mortality curve to price that particular instrument. So the point I'm trying to make is there are several such similarities between banking and insurance which might not be very apparent directly, but the way our curriculum is structured and the kind of things that we study, it definitely allows us to venture into banking and play a very impactful role from our perspective. So yeah.
All right, no, thank you very much. So effectively, we are already trained. We just never looked at the extent to which we can apply our skills in different areas. But really think seriously about banking. The young actuaries, the students, think seriously. You can walk in there. Yes, it can be difficult because the first thing you need to do is to understand the business. You have to understand the business model of a bank, the liability in a bank, and the asset in a bank is completely different from our traditional fields that we know. But you can literally walk in there, understand the issues, just based on our training. Within 6 months to a year, you can start running, and beyond that, you start gaining the much needed experience. Okay, we don't have enough time. I'm going to ask one last question to Vijay. Vijay, I mean, your very interesting, exciting presentation. My question is, you have interacted with actuaries, I assume, and I would like to know the skills that you have seen those actuaries that you believe actuaries possess, that they can apply within specifically a banking environment, noting that your presentation relates to both asset management and banking. Maybe a difficult question, but let's see.
From my interaction with actuaries, I found out that you guys study a lot of financial engineering and statistics, which people who study financial economics or financial engineering or quant finance also study. And also so many things in general finance like portfolio management and analysis and financial forecasting, etc. Are also part of papers in actuaries that people in finance also study. So I found a lot of overlap in actuary studies and financial studies, and never did I find out that I was out of place. In fact, the insurance calculations also, as my friend rightly pointed out, using example of CDS. So I found it very relevant. The CDS curve, term structure of interest rates. So everything is interrelated. Means so many things. So that is it. I mean, number of examples we can give that relate insurance actuaries with finance and
Okay.
banking.
Okay. No, thank you very much. Kailash, your experiences, and then you can close as well.
Sure. No, I think there is a lot of overlap when you look at the skill set required and the skill set that actuaries possess as a part of either the curriculum or the exposure that they get. I think the extent of complicated Markov chains that we deal in 2-stage, 3-stage, maybe even a 4-stage model is nowhere close to, say, a 2-stage model in a CDS Max, right? So given that background and given that, Michael, you chair the International Actuarial Association's working group on banking, I wanted to prick your brains on what is the roadmap for the next 2 years, maybe 2 to 3 years, one. And second, what is it that a fresher or say someone who's close to qualification should be looking at or exploring in terms of either an exposure to a project or internship and so on and so forth. I'm sure you're going to touch upon it in the next session. So I'm kind of just trying to establish the link. So
All right. Look, so we don't have enough time. There is the plenary session number 5 where we can have a lot of those questions and we can answer them. But effectively, when it comes to the banking working group of the IAA, I've been chairing that group for 2 years and I'm in my 3rd year. And the roadmap is very simple. Different jurisdictions are at different stages of understanding the work of actuaries in banking. So at the moment, it's a lot of awareness, more awareness work. So we do, we are doing a lot of seminars, especially at the biannually IAA meetings. We do banking seminar, banking specific seminar. One interesting one is coming in Washington, DC, course being sponsored by Society of Actuaries, Casualty Actuary Association, and Actuarial Society of South Africa, holding in conjunction with the banking working group of the IAA. We are also doing a paper, and I'm going to invite Yash, Vijay, whoever is interested, on application of actuarial techniques in banking. So we are writing a paper that I think in the next 12 months you will see it so that you can actually see where actuaries are, because this paper, the contributors are people who have been or who are exposed to the actual work. Apart from that, we continue to do, your webinars, articles. I don't know if the editors of the Actuary magazine of the IFOA, if they approve, there's going to be a few articles on banking coming through that some of you who receive that magazine can read. So it's a lot of, it's building work, more building and alerting actuaries around the world so that they can take action. Your second question, that one is more, and it's more to do with individual actuaries than anything. So this profession survives as a result of the work of individual actuaries. So we would say if you're a student and you've just finished, maybe you're struggling to get work in traditional areas of actuarial practice, try and cast your net wider and go to banks. Don't go and say, I am an actuary. Okay, in fact, I'll tell you why you shouldn't do that. There was a survey that was carried out in the UK. The deputy chair of the banking working group always refers to it. So they went to senior HR executives of banks and they said, if a person comes and has got these skills, then you outline all those skills of an actuary. Mathematically good, everything you want to outline about an actuary without mentioning the word actuary. Would you hire them? 92% said, yes, we would hire. Those are the people we want. But we were just describing the skill set of an actuary. Then another survey was held, or the next question was, what if that person, or what if an actuary comes and wants a job? Would you offer them a job? Just by saying actuary, 26%, only 26% said yes, we would do that. So there is a problem with our own marketing. So when you go out there, yes, say you're an actuary, but then say what an actuary is capable of doing. Don't just end by saying I'm an actuary. So that's what I would tell the young actuaries. Go out there, look for work. It's in South Africa, it was individual people who went into banks, and then banks started recognizing those skills that they have, and then it became a policy that a particular bank actually made it a policy that we are recruiting actuaries only in these particular areas, and that's it. So, but it starts with individual people, right?
Okay.
I think we let's come to a close. There's a lot to talk about. We will carry on in the next session.
Next session.
Thank you
Thanks,
very
Mike.
much.
On that note, I think we should give a big round of applause to Mike and Vijay and Yash. Thank you, guys.
May I request Mr. Kailash Mittal to felicitate our speakers?
Damn, son. Where'd you find this?
May I request Mr. Pravi Chandra please come on the stage to felicitate our chairperson, Mr. Kailash Mittal.